Regardless of how strict the rules and regulations are, the vast sums of money found in the financial sector have always attracted scammers. When millions or even billions of dollars are up for grabs, some individuals are willing to play dirty to get their hands on them. Here are some of the largest financial scandals in history. Number 1. Charles Ponzi. In 1919, Charles Ponzi, an Italian immigrant living in Boston, devised a method to make money by buying international reply coupons at a low cost abroad and then selling them for a profit in the United States. He persuaded other investors to back him, despite the fact that his business faced massive debts due to logistical issues and rising overheads. Ponzi just utilized the money from new investors to pay his old backers in what is now a well-known scam. Although not the first example of this type of scam, its notoriety gave birth to the term Ponzi scheme. Number 2. Bernie Madoff. The Bernie Madoff scandal was revealed in 2008. Bernard L. Madoff Investment Securities LLC was a Wall Street investment firm formed by Madoff, who scammed investors out of $64.8 billion through the largest Ponzi scam in history. Madoff and his accountants, David Freeling and Frank DiPascali, paid investors returns based on their own or other investors' funds rather than earnings. Madoff was sentenced to 150 years in prison and was issued a $170 billion restitution bill. Freeling and DiPascali were also sentenced to prison. Number 3. Enron. The 2001 Enron scandal was another notorious event prior to this incident. The energy firm failed to disclose massive debts on its balance sheet, costing shareholders $74 billion, thousands of employees and investors their retirement savings, and many workers their jobs. They were famously caught when Sharon Watkins blew the whistle after becoming suspicious of high stock prices. CEO Jeff Skeeling was sentenced to 24 years in jail. Former CEO Ken Lay was also sentenced to prison, but he died before serving time. Number 4. WorldCom. The telecommunications business that is now known as MCI overstated assets by up to $11 billion, resulting in 30,000 job losses and $180 billion in investment losses. The company's internal audit department discovered $3.8 billion in fraud. CEO Bernie Ebbers was revealed as the primary perpetrator, underreporting line costs by capitalizing rather than expensing and inflating revenues with false accounting entries. He received a 25-year sentence for fraud, conspiracy, and filing fake documents. The CFO was fired, the controller resigned, and the company declared bankruptcy. Number 5. Lehman Brothers. The most well-known accounting fraud case is the Lehman Brothers incident. The worldwide financial services giant concealed more than $50 billion in loans as sales. They sold toxic assets to Cayman Island banks, taking advantage of a loophole in accounting standard language surrounding repurchase agreements, with the expectation that they would be bought back later. The fraud was disclosed in September 2008, when Lehman Brothers declared bankruptcy. Number 6. HealthSouth. This healthcare corporation allegedly overstated its earnings by $1.4 billion to fulfill stockholder expectations. From 1996 until 2003, CEO Richard Scrushy was accused of directing employees to fabricate data and transactions. Cash and asset accounts were fabricated and pre-tax income was inflated. The SEC became suspicious when Scrushy sold $75 million in stock the day before the company reported a massive loss. Despite the fact that 5 senior executives pleaded guilty to federal fraud, Scrushy was acquitted on all 36 counts of accounting fraud. He was, however, accused of bribing the governor of Alabama, which led to a 7-year prison sentence. Scrushy continues to maintain his innocence and works as a motivational speaker. Number 7. Treaty of Utrecht. One of the first documented incidents of accounting fraud in the United Kingdom dates back to the 18th century. In 1720, the United Kingdom signed the Treaty of Utrecht 1713 with Spain, permitting it to trade in the oceans near South America. In reality, almost no trading happened as Spain renounced the treaty, but this was hidden on the UK stock market. A parliamentary inquiry discovered fraud among government officials, including the Tory Chancellor of the Exchequer, John Aislaby, who was sent to prison. Number 8. Nick Leeson. This case exposed a severe lack of oversight in financial reporting, which contributed to the bankruptcy of the UK's oldest investment bank. Nick Leeson, then the head of derivatives at Barings Bank Singapore, caused a catastrophic financial crisis that led to the bank's downfall. The rogue trader spent over $1 billion on unhedged market positions, falsifying internal accounting documents to hide his actions. When the markets failed to turn in his favour, the losses grew. Surprisingly, Leeson's acts were uncovered not through an internal audit or oversight, but through a letter of confession delivered to the bank's president as his losses accumulated. Number 9. Americanas SA. The accounting fraud at Brazilian retailer Americanas SA, which resulted in a $4 billion imbalance on its balance sheet, centers on a popular but obscure financial practice known as supplier finance. This method, also known as supply chain finance or reverse factoring, can take advantage of lax accounting regulations to make a company's financial situation appear better than it actually is. An independent committee's report presented to Americana's board indicates that management manipulated financial records for years, culminating in the company's bankruptcy filing in January 2023. Number 10. Satyam. This worldwide IT corporation based in India inflated earnings by $1.5 billion by misrepresenting revenue, margins, and cash balances. Ramalinga Raju, the company's founder and chairman, confirmed the wrongdoing in a letter to the board of directors. He and his brother were charged with breach of trust, conspiracy, cheating, and falsification of records. However, both were released because the Central Bureau of Investigation failed to file charges on time. In his letter to his board, Raju states, "What started as a marginal gap between actual operating profits and ones reflected in the books of accounts continued to grow over the years. It has attained unmanageable proportions." Later, he describes the process as like riding a tiger, not knowing how to get off without being eaten. Finally, the financial sector is complicated, making fraud difficult to prevent and detect. However, understanding how some of the most well-known financial crimes occurred is a strategy for preventing future crimes. So, what are your thoughts about today's video? Don't forget to leave them all in the comments section below.